Hi, I'm Jim Juback, and this is my Juback asset management video for Wednesday, January 10th. Um, it's been a long hiatus, as some of you know, or as you all should know since I've announced it. I moved this whole kit and caboodle and myself to Italy. I'm in Venice at the moment, wearing my old Toledo Mud Hens hat, but also a University of Venice t-shirt to indicate we're in transition from one to the other. Okay, today's topic is will we have a Santa Claus Rally Hangover in January? We've started off January with a kind of week that has led a lot of people to say, oh, we're going to pull back, we're going to pull back. Um, what's important really to remember here is that Wall Street and people like myself were really wrong about 2023, that most of us missed the October to December rally, that the primary focus of commentary was, hey, we're going to see, when we hit the October lows, the comment was, we're going to see lower lows, we're going to go down for the rest of the year. Wall Street is being investors are being over optimistic about the speed at which the Fed is going to cut rates. When they get news in December that rate cuts are going to be delayed, we're going to get a retreat. Well, we didn't get the news that the rate cuts are going to be delayed. The Fed basically said, yeah, we're going to cut rates in 2024. The market rallied, and that's really the setup for understanding what's going on right now. Because because so many people were wrong about 2023, there's an effort to sort of recoup that wrongness by saying, hey, we're going to get a retreat to the trend line, to the norm, we're going to get a reversion to norm. And there's some good reasons to believe that this is possible. One is that, well, the valuations here are so stretched. I did a little research. And so if you look at PE, the raw PE for the S&P 500, right now it's about 26. Long-term average is about 18. So you can see 26 to 18, we're really overvalued. If you look at something that sort of cranks a little revision or a little more sensitivity into the data, you look at the CAPE ratio. And this really tries to do a PE ratio for the S&P 500 by looking at a 10-year earnings average. It tries to take out the effects of the business cycle. So what you get basically, though, is the CAPE ratio right now is around 31. The average over the last 10 years is about 20. So see, 31 to 20, you still got extreme overvaluation. So the real question is, if you look at this and go, okay, so we do have an overvalued market. We do have a big rally. So maybe you are getting some selling right now, and I think you probably are. People are taking profits. But is that going to break down into something else? And I think the things to look at right here are, one is the economy still looks pretty decent. The last jobs numbers, which were for December, looked relatively strong, even if you looked at some of the weakness in the underlying numbers. So there's really nothing there to say, hey, we really want to take some money off the table here beyond profit taking. So we've got an end of the month Fed meeting, January 31st. Nothing much is going to happen. No one's really counting on the Fed to do anything. So what we're going to do is we're going to move into earnings season, starting really at the end of this week, starting on Friday, and then really kicking off the following week. So the question there is right now, analysts have been cutting their estimates for the S&P earnings. So they're basically predicting a pretty weak earnings season. That's not priced into the market. There's a big difference between expectations based on the Fed and expectations based on earnings they haven't yet met. If earnings turn out to be sufficiently bad, and particularly guidance going forward, you might see this the reversion to the mean selling get a little more heated. But really the question is going to be what happens when the Fed meets on March 20th. I think, again, you're going to see a lot of people try to position themselves for the possibility that the Fed will say, hey, you guys are ahead of yourself. We're not going to cut rates on March 20th, which is an expectation in the market. And we're not going to cut 5 times, which is also the expectation in the market, 4 or 5 times. So a total of at least 100 basis points of interest rate cuts sort of baked in right now. So if you're looking at this, I think a kind of January, some in February, some positioning to say, hey, let's not put everything on the table on the bets that the Fed is going to follow the playbook in March, and then a real question of in March what happens, and what does the Fed do? What does the Fed say? I don't think we're going to get the March cut, but I think the market is probably willing to say, okay, so it's not March, and it's probably going to be June, and maybe it's not 5 cuts, but maybe it's 4 or 3, but still we're looking at interest rates going down. I think we're not looking at anything here internal to the market that suggests a big sell-off, but the sort of first quarter of the year. It's been Jim Jubak. Thanks for watching. If you want to see more of my videos, tune into this, they're on this YouTube channel. You can also see more of my stuff on my free site. That's jubakpicks.com. And there are 3 portfolios on there, or you can get 5 portfolios or 6 on my paid site. That's jubakam.com, and you can find links to all those down below. Thanks very much for watching.